There is a version of what is happening in silver right now that never makes it onto the financial channels, and it is the only version that matters. The loud money gets all the airtime. The quiet money gets all the metal. And if you are only listening to the loud money, you are being told the exact opposite of what the people who actually move truckloads of silver are doing. So let me say this plainly, because it is your retirement I am talking about. If you are holding silver, or you have been thinking about it, the single most useful skill you can build is learning to tell those two groups apart. One group trades a screen. The other group takes delivery of the actual bars. When they disagree, and right now they quietly disagree more than they have in years, the smart thing is to watch what the second group does with its money, not what the first group says with its mouth. By the end of this, you will know exactly who to follow and why. Here is the appetizer, and it is a durable truth, not a headline. In the silver market, there are two kinds of players who show up in the official positioning data every single week. There are the trend-chasing funds, the ones the reports call managed money, who pile in when the chart looks exciting and dump the moment it gets scary. And there are the commercial buyers, the physical hands, the refiners and industrial users, and the desks that actually stand for delivery and haul metal out of the vaults. Those two groups do not behave the same. They almost never have, and the gap between what the funds are doing and what the physical buyers are doing is the real story that the title brought you here to understand. Let me show you why that gap is everything. When a trend-chasing fund buys silver, it does not want silver. It wants a number to go up so it can sell it to someone else for a higher number. It has no use for a single ounce of the actual metal. It is renting exposure. And the thing about renting is that you leave the moment the weather turns. That is why fund money is loud and fickle. It floods in near the top, when everyone on the platform is suddenly a silver expert, and it stampedes for the exit at the first hard shakeout. The financial media loves this money because it makes for exciting television. Big green candles, big red candles, breathless updates. But it is the least informed money in the entire market, and the desks that sell it its exposure know that better than anyone. Now look at the other group, the one nobody puts on television. When a commercial buyer or a physical hand acquires silver, it is because it needs the metal, or it wants to own the metal outright, off the exchange, in a vault it controls. That buyer is not renting. It is not going to panic sell into a dip because a chart looked ugly for a week. It bought the bars for a reason that has nothing to do with this month's momentum. And here is the part the loud money never understands. On the futures exchange, the commercial side usually shows up as net short in the data, and every headline writer who does not understand the mechanics screams that the commercials are bearish, that the big players are betting against silver, that you should be afraid. That reading is not just wrong, it is close to the opposite of the truth. Let me untangle that, because this is the exact confusion the big trading desks are perfectly happy to let you keep. A commercial short is very often a hedge, not a bet. A refiner or a dealer that is holding physical metal, or that has metal coming, sells futures against it to lock in a price so it can run its business without gambling on the daily swing. That short position is the paper shadow of a very real, very physical long position in actual bars. So when you see commercials net short, what you are frequently looking at is a group that is sitting on metal and simply protecting it. It is the signature of people who own the physical and are managing it like professionals, not the signature of people betting silver goes to nothing. The headline says bearish. The behavior says accumulate and protect. Learn to read the behavior. And here is the tell that pulls it all together, the thing that no amount of chart drama can fake. Follow the metal itself. On the main exchange, the registered inventories, the bars actually available to satisfy delivery, have been drawn down hard over the last several years, a long way off the highs they hit at the start of the decade. The big London vaults sit well below their peak too. Metal has been leaving. And in stretches like this one, the demand to actually stand for delivery, to say no thank you to a cash settlement, and instead take the physical bars off the exchange, has been firm and persistent. That is not renting. That is not a fund chasing a candle. That is quiet, patient money converting paper claims into metal it can hold. And it does not show up as a headline because it is not supposed to. It is the second group doing what it always does, while the first group provides the noise. This is where I want to be honest with you about the stakes, because this is exactly the point where a lot of retirees get hurt. When the loud money is net long and excited, that money is fuel for a shakeout. Funds that piled in on momentum are the same funds that get flushed out the first time the price drops hard. And when they run all at once, and the drop feeds on itself. If you do not understand the difference between the two groups, that shakeout will feel like the end of the world. You will watch the metal fall and assume the smart people are getting out, when in reality, it is only the tourists getting out, and the physical hands are quietly standing there with a basket. The tragedy is the retiree who sells his real metal into that dip, hands it to exactly the patient buyer he should have been imitating, and then watches it recover without him. And that is the perfect moment to tell you about the thing the biggest, most patient buyers on earth have been doing, because you are allowed to do it too. The central banks, the ultimate physical hands, have been buying gold at a record pace, more than 1,000 tons a year for 3 straight years running, roughly double what they averaged the decade before. Gold recently passed the euro to become the second largest reserve asset that central banks hold, behind only the US dollar. They are not renting exposure on a screen. They are taking delivery of metal into their own vaults. And there is a little known, completely legal way for an ordinary American retiree to do the very same thing inside the retirement account you already have. You can move a portion of an existing IRA or 401k into physical gold and silver, real bars and coins held in an insured depository in your name, without triggering taxes and without an early withdrawal penalty, because it is a transfer and not a distribution. This is not some exotic club for insiders. If you have $100,000 or more in any retirement account, this is available to you. I put together a free retirement protection guide that walks through exactly how it works step by step in plain English. If you are watching this on your television, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. It costs you nothing to understand your options, and understanding them is the whole point of what we are doing here. Now, let me take you deeper, because there is a structural reason the physical buyers are so calm about accumulating while the funds thrash around. The silver market has been running a supply deficit for several years in a row now. That means the world has been using more silver than it digs up and recycles, year after year, and the gap has been filled by drawing down the metal that was already sitting above ground. That is the quiet backdrop the trend-chasing funds never think about. They are watching a 5-minute chart. The physical buyers are watching a multi-year hole in the supply. And unlike gold, which is hoarded and mostly comes back, a great deal of silver is used and gone. It goes into solar panels and electronics and 1,000 industrial applications in tiny amounts that are simply not economic to recover. Gold is hoarded. Silver is burned. Every year, the burning continues. The above-ground pile that could be delivered gets a little thinner, and the people who take delivery know it. Here is a detail that ought to stop you, because it cuts against everything the headlines would predict. There was recently a sharp pullback in one of silver's biggest sources of industrial demand, a real cut, the kind of thing that on paper should have flooded the market with surplus metal and crushed the price. And yet, the market stayed in deficit anyway. Think about what that tells you. Even with a major buyer pulling back, the world still could not produce enough silver to cover what it needed. Because the real problem is not runaway demand, it is that mine supply itself has been shrinking. When the shortage survives a demand cut, you're not looking at a fad, you are looking at a structural condition. And structural conditions are exactly what patient physical money positions for, and exactly what fickle fund money is incapable of seeing. Then there is the East, which is its own quiet accumulation story. Physical silver in Shanghai has effectively decoupled from the Western benchmarks, trading at a persistent premium to London and to the main US exchange. Strong physical demand out of China, combined with tight state-controlled export channels that keep the metal from flowing back out, has been throttling the normal mechanism that would rebalance the two markets. In a freely connected world, a premium in one place gets arbitraged away as metal flows to where it is dearer. When that flow gets choked, the premium persists, and a persistent premium is the market screaming that physical demand is outrunning physical supply in the place that wants the metal most. Again, that is not a chart pattern. That is real bars being pulled in and held. Now here is the midpoint rehook, the part that actually changes how you should watch every silver headline for the rest of your life. Ready? The financial media reports on the loud money and calls it news. Managed money went net long, silver rallies. Managed money got scared, silver falls. That is not analysis. That is a weather report on the tourists. The real signal is always underneath it, in the delivery data and the vault drawdowns and the premiums, in the behavior of the group that does not talk. And the reason nobody hands you that signal on a silver platter is that the desks and the brokers who sit between you and the metal make their living on your churn. A frightened retiree dumping real silver into a shakeout is a paying customer. A calm retiree who understands the difference between renting and owning is not. That is the business model. That is why the version of this story that matters never makes it onto your screen. Let me give you the history that proves the paper game can turn on the loud money in an instant, and why the physical hands are the ones who sleep at night. A number of years ago, in a violent stretch, the exchange sharply raised the margin required to hold silver futures, and the price fell around 30% in a matter of days. Nothing about silver itself had changed. Not the supply deficit, not the industrial demand, not a single fundamental. What changed was the cost of holding the paper, and the leveraged, trend-chasing money got flushed out the door, because it had to be, because that is what leverage does to you in a squeeze. The people who owned physical metal outright, with no margin call hanging over them, did not have to do anything at all. They watched the tourists get carried out, and they kept their bars. That is the whole lesson in one episode. The paper rules can change on you overnight. The metal in a vault in your name cannot be margin called. We have seen the paper promise fail in even starker ways. Not many years ago, on a metals exchange in another market, when a violent short squeeze meant that paper claims were about to lose badly to the people who wanted the actual metal, the exchange did something extraordinary. It canceled completed trades. It reached back in time and unwound deals that had already happened to protect the paper side. If you ever needed proof that a paper claim on metal and the metal itself are two entirely different things, that was it. And a few years back, an army of retail buyers tried to squeeze silver by buying paper claims, and it went nowhere. Because buying a paper claim just tells someone to write another paper claim. It creates more paper. It does not create one new ounce. The only thing that actually tightens a physical market is pulling physical metal out of it, which is precisely, quietly, what the group you should be following has been doing all along. I want to slow down and talk to you directly about your own position, because none of this is worth anything if it just makes you anxious. Here is how a sensible retiree thinks about it. First, if you are going to own silver as protection, own the metal, not a paper promise, so that no exchange, no broker, no rule change can stand between you and what you own. Second, size the position so that a sharp drop, and there will be sharp drops, cannot force your hand. The whole disaster of the shakeout is forced selling. People who bought too much with too little cushion and had to sell at the worst possible moment. If your position is sized so that a 30 or 40% air pocket is uncomfortable but survivable, then you get to be the calm physical hand instead of the panicked tourist. And third, do not sell into the shakeout. That is the single most expensive mistake in this entire arena. The dip is when the metal changes hands from the people who react to the people who accumulate. Decide in advance which of those you intend to be. Now, let me bring it home, because this is the recognition moment, and it is the part that nobody will spell out for you on the evening news. Right now, the group that takes delivery already sees it. The physical buyers, the commercial hands, the central banks stacking metal into their own vaults, they are positioned. They did not wait for permission, and they did not wait for a headline. The mainstream money, the pension funds, the financial press, the ordinary saver who only hears the loud version, has not caught on yet. And that gap, that quiet stretch where the smart physical money is accumulating and the crowd is still distracted by the noise, is the whole opportunity. Because by the time it becomes obvious, by the time silver leads every broadcast and every advisor on television is suddenly recommending it, the physical will already have been pulled, and the easy part of the move will already be behind us. You will not get a phone call. Nobody sends an ordinary retiree an invitation to be early. The invitation is understanding what you just understood before the crowd arrives. And that brings me to the honest caution, because I would not respect you if I skipped it. I cannot tell you a price, and I cannot tell you a date. Silver is volatile, genuinely volatile, more than gold, and it can and will have drops that test your stomach. This is a case built on structure and behavior, on a real multi-year deficit, and on the observable difference between money that rents and money that owns. It is a strong case, but it is a case, not a guarantee, and nothing I have said is personal financial advice for your specific situation. What I am giving you is a lens. The lens the physical buyers use, so that the next time the loud money panics and the screen turns red, you understand what you are actually looking at. So here we are, back where we started. Is Wall Street quietly loading up on silver? The loud part of Wall Street, the trend chasing funds, is doing what it always does, piling in when it is exciting and setting up the next shakeout. But the quiet part, the physical hands and the commercial buyers and the delivery desks, has been steadily converting paper into metal, drawing down the vaults and standing for the bars while the deficit grinds on underneath. That is the loading up that counts. That is the money to follow. Not the mouths on the screen, the hands on the metal. And if everything I have walked you through resonates, here is your next honest step, especially if you stayed with me all the way to the end. For those of you with $100,000 or more in a 401k or an IRA, I am offering a free, no obligation, one-on-one educational web conference. It is a real conversation, not a sales pitch, about how to think about protecting a portion of your retirement with physical gold and silver inside the account you already have. Just mention that you watched this all the way through. And here is the honest why now, with no fake countdown attached. The right time to make a calm, clear-headed decision like this is precisely when nothing feels urgent, when the crowd has not yet arrived and you still have room to think. The moment it becomes obvious to everyone is the moment your options get worse. If you are watching on your television, scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. Take the quiet path. Be the hand on the metal, not the voice in the noise. And I will see you in the next one.